Good morning, guys. Welcome to my channel, Learn Accountancy with Prasad R. Last weekend, I posted a video on deferred tax. Over the week, I had a thought that why not put videos on simplifying IND AS. So I will be posting a weekend series where I will be discussing about various IND AS. And today's topic of discussion happens to be IND AS 16, which is property, plant, and equipment. Please like, share, and subscribe my channel, Learn Accountancy with Prasad R. This is the second topic on IND AS, which is property, plant, and equipment. The previous video on deferred tax is available in my YouTube channel, so you can check the video on deferred tax and deferred tax liability in my YouTube channel. So let's start discussing IND AS 16 property, plant, and equipment. And this is going to be a weekend series. It's going to be short videos explaining the concepts in detail about IND AS. Okay. Before discussing or getting into an accounting standard, it's very important to understand the why behind the accounting standard. Now, there is an accounting standard framed by ICAI and various other accounting bodies on property, plant, and equipment. Why IND AS 16? Why there is a standard on property, plant, and equipment? Okay. So, what we'll be discussing in this standard is one, we will be discussing about the recognition criteria. When we do a transaction or when we purchase something, whether that qualifies as an asset, whether that meets the recognition criteria, we call it as the recognition criteria. Whether that particular item qualifies as the recognition criteria, that will be discussed in this trend. When we purchase an item, what are the costs that can get into the valuation of property, plant, and equipment? At what value we should capitalize the asset? That will be discussed in this standard. We'll be discussing a little on depreciation as well. This standard covers both capitalization as well as depreciation. Okay. So the definition is another important aspect of the standard. Not only this accounting standard, guys. Whenever you get into an accounting standard, first understand the reason why this accounting standard came into existence. What were the complexities that gave rise to a standard on property, plant, and equipment? Okay. So first, we'll be understanding the definition of property, plant, and equipment. Then we'll be discussing on the recognition criteria. And we'll be also discussing about what can be included in the cost of property, plant, and equipment, what will be excluded from the definition of property, plant, and equipment. And in the last few slides, we will be discussing about what happens if a one particular asset had multiple components with different useful life. Okay, let's get into the standards. Accounting standard happens to be one of my most liked topics actually. So I thought when I have to start a series, so it will be more relevant if I start with something which I like and which will be useful for the students actually. So let's discuss about what is a property, plant, and equipment. As per IND AS 16 in para number 6, they have defined property, plant, and equipment as a tangible asset. So what do you mean by tangible? Anything which has a physical presence or physical substance, that is called as a tangible asset, something which we can touch, like from the laptop in which I am recording this video is a tangible asset. The chair that you will be sitting is a tangible asset. The building in which you are residing, that is a tangible asset. So something which has a physical substance is called as a tangible asset. Okay. So under para number 6, I have broken down this definition into three components to make it simple. So the standard tells that it has to be a tangible asset, something which is held for production. Stay with me, guys. Held for production, supply of goods or services, for rental to others, or for administrative purposes. Each word has a meaning actually. So it has to be a tangible asset which is held for production. What is held for production? A plant and machinery. Suppose there is a manufacturing entity and they have plant and machinery. They have bought plant and machinery to manufacture shirt or manufacture utensil or to manufacture anything actually. So the plant and machinery, if it is held for production or supply of goods or services, in case of IT companies, they will be rendering their services through laptops. The employees will be given laptops, or in case of a consultancy like Big Four, most of the employees they will be rendering services through their laptop actually. So anything which is held for production or anything which is used for supply of goods or services. So in case of IT industries, the most of the services are supplied through laptops. So the laptop is will qualify as property, plant, and equipment. Next is for rentals given to others for rentals. Actually, I have we have two buildings in our company. One is used for official purposes. Another building is vacant. The vacant building is let out to someone for a rental uh, arrangement. So the building that is given on rental for other, that also qualifies as a property, plant, and equipment, or for administrative purposes. What do you mean by administrative purposes? The first line of the definition discussed about anything which is held for production or anything which is held for rendering services or for supply of goods. This is the main activity of any business, either doing a production or rendering services. But assets are also used for administrative purposes, right? Like I handle the taxation for my company. Okay. Now I am not a revenue generating resource, or anyone who is in HR finance, they are not a revenue generating resource. But they will be using this laptop to render finance function services, to render HR services, to render admin services, although they are not generating revenue for the company. So these services are called administrative services. Any asset held to provide administrative services also will qualify under the definition of property, plant, and equipment. Okay. So combining the first two legs of the definition, it has to be a tangible asset. Second, it should be the asset should be used for production or supply of goods or services, or it can be given to rental to others also. Like I gave an example that there are two buildings, one building is given for rental, that also will qualify as property, plant, and equipment. Or it can be for the asset can be used for administrative purpose also, like to render an HR function, to render a finance function, or to render an admin function actually. Okay. And one more condition that is given is it is expected to be used for more than one accounting period. See, in general parlance, if the particular asset is expected to be used for more than 1 year, then it can qualify for property, plant, and equipment. So all these conditions put together has to be satisfied for the asset to qualify as a property, plant, and equipment. This is only the definition as per IND AS 16 given under para 6. Okay, so I have broken the definition into three parts. One is it has to be a tangible asset. Second is it has to be held for production or for supply of goods or services or for rental to others or administrative purposes. And third is it it should be expected to use for more than one accounting period. That means if an asset is not expected to be used for more than 1 year, we can directly take it to expenses. We can directly charge it to the profit and loss account. For example, uh, a mobile which is expected to be used only for 1 year, you know that the mobile will not survive more than 1 year, then it can be taken directly charged to expenses. If the same mobile is expected to be used for more than 1 year, then that can qualify as a property, plant, and equipment and can be capitalized as. Clear? So this was the first part of IND AS 16. This was only the definition that we have discussed so far, guys. Okay. The next important part is the recognition criteria. See, in every standard, most of the standards are built like this, guys. There will be, when you take the revenue recognition standard, IND AS 115, it will also have a definition, it will also have a recognition criteria. So what is the recognition criteria uh, in terms of for property, plant and equipment? Two conditions has to be fulfilled. One is there has to be a future economic benefit. Second is the cost can be reliably measured. And these terminologies that I'm using that you see in the screen are almost standard. If you take IFRS also, it is similar. In fact, the IND AS is more aligned to IFRS. So the terminologies that will be used there is almost similar. And in fact, previously prior to IND AS, we had accounting standards. So it was AS10, if I recall it right. So under AS10 also the terminology was exactly the same. And very, very important condition wise. Now we have understood the definition of property, plant and equipment, but what are the conditions to be met to capitalize a property, plant and equipment? Two conditions are given in the standard. One is they call it as future economic benefit. What is a future economic benefit? Future economic benefit means by using this particular asset, either it should help me in generating revenue or it can help me in decreasing cost also. So it can, like for example, in the definition we discussed about something which is used for production of goods or supply of services. Production of good and supply of services both does what? Both helps in generating revenue. So that means there is a future economic benefit attached to uh, obtaining that asset or keeping that asset. That is exactly what is meant by future economic benefits. Or giving for rental to others, or for giving for rental to others, that was given in the definition part. So when we give a building for rental to others, there is a future economic benefit. So whenever there is a future economic benefit combined with cost can be reliably measured. So these two conditions has to be cumulatively satisfied. Then only the recognition criteria is satisfied. So one is there has to be a future economic benefit. Future economic benefit means what? When you possess that asset, when you have that asset in the company, either it should generate revenue or it should bring down the cost. Okay, so that is meant by future economic benefit. That means the asset should give you some future economic benefit. Okay, a production machine generates future economic benefit. Office furniture provides administrative benefits. So all these are future economic benefit, and cost can be reliably measured. See, to capitalize the item in the books of account, to record an particular asset in the books of accounts, you need to have the cost right. So this is a very basic condition that is given in the standard. One is it should give future economic benefit, and it is telling that the cost, we should be in a position to quantify the cost. The quantification of cost is important to record that asset in the balance sheet or to record that asset in the books of account. Okay. Okay. So here in this case, if we purchase a machinery, then we know the price of the machinery that can be capitalized. But if it's a donated asset without fair value, if it's a donated asset, then it may be difficult to quantify what should be the value that we should capitalize. In that case, the second condition will not get satisfied. In that case, we may not be in a position to capitalize. If we are able to derive the value, then we can capitalize such cost. Clear, guys? So far we have discussed about the definition. Second thing we discussed about the recognition criteria. Recognition criteria is very simple. One is it should give future economic benefit, and second, the cost can be reliably measured. The same language is given in the standard for intangible asset also. The same conditions are there in intangible asset also. When we discuss that, we'll be discussing the same two conditions in intangible asset. Okay. And this happens to be one of the most important interview questions also. They can always test you on what is the recognition criteria for property, plant, and equipment. And in exams also, it can be tested where uh, there will be some questions given and you have to justify whether this particular cost can be capitalized or not. If there is no future economic benefit, it cannot be. And if the cost itself cannot be measured, then we cannot definitely capitalize them. Clear? Now, this is the most interesting part again of the standard. What goes into PPE, guys? What goes into PP? Okay. See, if I ask a 11th standard guy also, I purchased an AC for 10,000 rupees from uh, from any store for that matter. I purchased an AC for 10,000 rupees and I incur a 1,000 rupees cost to bring the AC to my house. And there is another 1,500 cost which is required to install the AC. Okay. So the AC assuming is 40,000 rupees. This is the purchase price. Okay. Transport is 1,000 and installation is 1,500. If I ask 11th standard guy also, they will tell that the cost to be capitalized is 40,000 plus 1,000 is 41,000. The total cost to be capitalized is 42,500. Amazing. 11th standard guy also knows what cost to be capitalized. But where this is coming from actually, this 1,000 and 1,500, we all know the purchase cost has to be capitalized. When we talk about the purchase cost, any trade discount has to be reduced. Trade discount is not at all accounted anywhere. Any taxes, see this 40,000 rupees will include GST also, right? So any taxes which are attributable. See, in case of taxes, if we can claim the input credit, that goes separately. In case we are not able to claim the input credit, then the taxes will form part of the cost of capitalization. Okay. Import duties and non-refundable taxes. See, they have mentioned, use the word non-refundable taxes. Okay, let me break down this into two. 40,000 rupees for a moment. Okay, you forget about the GST part of it. Let's keep it simple. Okay, I will talk about GST separately. 40,000 rupees is the purchase price. Transportation is 1,000. Installation is 1,500. The amount to be capitalized is 42,500. Assuming this includes 40,000 rupees is the same, plus there is a 2,000 rupees GST in this. So this 2,000 rupees GST, in case we are able to claim the GST, that means the GST input can be claimed. This 2,000 rupees goes separately as GST input credit, and the amount to be capitalized is 42,500, and 2,000 rupees will go and sit as GST input receivable, GST input receivable, which can be set off against the GST output liability. That's a separate discussion. I will not get into much of the GST part of it. So what can be capitalized? The purchase price, any import duties and non-refundable taxes. Why non-refundable taxes? Because if the taxes are can be claimed, then it goes into a separate ledger as GST input that can be offset against the output liability. So non-refundable taxes we can capitalize. This is very important, guys. Directly attributable cost to bring the asset to working condition. See, when we buy an AC, can you start using the AC without installation? It is not possible. We cannot use the AC without installation. So that means the asset is not in a condition which is ready to use. So the standard uses two words to bring the asset to a location and to bring the asset to a condition which is condition for ready to use. Okay. So to bring the asset to a location. Now I stay 10 kilometers away from the shop. My office is 10 kilometers away from the shop. I purchased an AC 10 kilometers away. So what will the shopkeeper do? The shopkeeper will tell boss, I will shift the AC to your office, but the transportation cost is 1,000 rupees. So to bring the asset to a location, to bring the asset to a location so that the AC can be used. So the wording in the standard given is to bring the asset to a location which makes it ready to use, and to bring the asset to a condition. So here what will be covered? Installation. Without installation, the asset will not come in a condition which is ready to use. Here what will come here is freight charges. What will come here is freight charges or transportation charges. Now, this transportation charges, why it was capitalized? Because the standard tells that capitalize the cost, include in the cost the price which is spent or the amount which is spent to bring the asset to a location to make the asset ready to use. So this 1,000 is capitalized because the standard tells that to bring it to the location, whatever cost is incurred. To make the asset ready to use, whatever cost is incurred needs to be capitalized. And why this installation cost is capitalized? To bring the asset to a condition. See, without I have the AC now. If the AC is not installed, can we use the AC? We cannot use the AC. So to bring the asset to a condition which is ready to use. So installation is to bring the asset to a condition which is ready to use. This is to bring the asset to a location which is ready to use. These are the wordings which are given in the standard price. So purchase price, any cost which is directly attributable to bring the asset to a location and condition ready to use can be capitalized. A classic example is, for example, you are going to buy a very high-tech machinery which is only available in Singapore. Now you give a report, an import request. You import the machinery from Singapore, and to bring the machinery, definitely there has to be some insurance also done because the machine from Singapore to India will come either from flight or through sea, right? So the insurance cost will also be capitalized because it is a cost which is incurred to bring the asset to a location and condition which is ready to use. And after it comes from Singapore to India, there has to be installation. So the installation cost also can be capitalized. Okay. And see, in case of oil refineries, if you want to set up a new oil refinery, first you have to dismantle the old oil refinery and then only you can uh, install the new refinery. So the initial estimate of dismantling and restoration cost can also be capitalized. These are all given in the standard guides. What goes into the property, plant and equipment cost? Purchase price, directly attributable cost to bring the asset to a location and condition which is ready to use. Then import duties and non-refundable taxes. It's very important, guys. Non-refundable taxes. Any tax which can be claimed as input credit will not form part of the cost of plant and property, plant and equipment. Clear, guys? Okay. So we discussed about cost which can be included. Again, the same thing: installation and assembly cost, freight and handling. So this is to bring the asset to a condition for ready to use. This is to bring the asset to a location which is ready to use. Professional fee of architect and design. See, in case of building, if you are decided to purchase a building or construct a building, you will be hiring architect and engineers, right? So those costs also can be capitalized. What cost cannot be capitalized? A training cost. To run the machinery, if you are training an employee on how to run the machinery, that cost cannot be capitalized. Advertising and promotional activities. Advertising and promotional activities cannot be capitalized. Administration overhead cannot be capitalized. Opening ceremony. Now you have a office ready. The office is in a working condition. Now you invite your employees and their family and chief guest to inaugurate the office. Can the opening ceremony cost, can it be capitalized? No. Any directly attributable cost to bring the asset to a location and condition to make it ready for use only can be capitalized. The asset is already in a position to be used actually. And this cost is not a directly attributable cost. So this cannot be capitalized. In fact, in CA Inter, you can be tested on uh, to inaugurate a building, some cost was incurred on ceremony cost, whether that can be capitalized. You have to mention that those costs cannot be capitalized. Operating losses during initial period. See, sometimes it happens that the asset is ready to use. Like for example, in case of Wonderla, which recently opened in Chennai, there is a Wonderla in Bangalore also. So what they do some initial trial runs before the general public can start using it. They do a trial run actually, an amusement park. So The trial run cost, whatever is the trial run cost, that means the asset is not ready to use. Although it is ready to use, but no one wants to take a risk. They do a trial run for 3 months actually. So whatever cost is incurred during the trial run phase, that cannot be capitalized. And this also happens to be one of the CA intermediate question where they have this question on amusement park, and the amusement park trial run cost, 3 months of trial run was done, and there was certain cost incurred during the trial run. Whether that cost can be capitalized or not, it cannot be capitalized. Clear, guys? Okay. A very simple example. I think by now you will be in a position to answer this on your own. There is a purchase price of 10 lakh. This is a similar example I took. 10 lakh, installation of 80,000, freight of 40,000. What can be capitalized? Purchase price, yes, the standard tells any cost which is incurred on purchasing definitely can be capitalized. Installation, to bring the asset to a condition. This is to bring the asset to a condition. See, I'm repeatedly using this word condition and location is so that those words gets registered in your mind because this is the language which is used in the standard. Condition for ready to use. Ready to use. Okay, freight. This is to bring the asset to a location. Directly attributable cost. This both are directly attributable cost. This is to bring the asset to a condition ready to use. This is to bring the location to bring at the location to make it ready to use. Okay. So the standard allows this is a directly attributable cost. This is a directly attributable cost. This can be capitalized. This cost cannot be capitalized. Training cost is not allowed. In the previous slide, we saw that as an exception, this cost cannot be capitalized. So what can be capitalized? 10 lakh plus 80,000 plus 40,000, 11 lakh 20,000 can be capitalized. And where this will go? This cost will go to the profit and loss account. You have to charge it as expenses. This cost will be treated as expenses will go to the profit and loss account. Clear, guys? So what will be the journal entry, guys? Very simple. Asset account debit to bank account. Increase in asset has to be debited. Asset account debit to bank account. So property, plant and equipment account debit to bank account, or property, plant and equipment account debit to vendor. Vendor account debit to bank account will be the accounting. For training expenses, charge it off. Training expenses account debit to bank account. Expense directly will go into the profit and loss account, guys. Clear? Now, in this standard, they have discussed about subsequent measurement model. See, there are two models which the company adopts, either a cost model or a evaluation model. I will be touching this in very brief, not in detail. See, generally, most of the companies they opt for a cost model. That means the asset, once it gets recorded in the books of account, it will be always carried at cost. Asset will be always carried at cost less accumulated depreciation and impairment losses, if any. Okay. So in this model, the asset will be always shown as cost less what? Accumulated depreciation. This will be the net book value of the asset. In case of revaluation model, what happens? And this is the most uh, prevalent method which is used by most of the companies. In case of revaluation model, what happens? Assets are carried at fair value. That means after a certain period of time, the asset has to be revalued actually. Like the building today is 10 lakh. If I follow a cost model, today I am in 2026. In 2026 also, 36 also the building will be staying in my books at uh, if I bought a building today at 1 crore in 2026, in 2036 also the books in if I see my books, the gross block of the building will be at 1 crore, less accumulated depreciation obviously. But in case of revaluation model, today the building is 1 crore. In 2030, it may be 1.5 crores. So I can do a revaluation in 2030. My building cost will increase from, price will increase from 1 crore to 1.5 crores. Okay. So there will be a upward revaluation of the building. Okay. So it has to be carried at fair value. Revaluation surplus goes to where? It goes to other comprehensive income. In the financials, below the profit before tax. Okay. Below the profit before tax, then comes taxation, then profit after tax. After profit after tax, there comes comprehensive income. So it goes into other comprehensive income. Below the profit after tax, this amount goes in other comprehensive income in the balance sheet. Any upward revaluation will go to other comprehensive income. Clear, guys? And once we do a revaluation, now the building value has become from 1 crore to 1.5 crores, means the depreciation will be charged at the revalued amount for the remaining useful life. If the useful life is say 15 years and already 5 years have expired, so the remaining useful life is 10 years. So whatever is the revalued amount, that the depreciation will be, the remaining depreciation will be charged at the revalued amount for the remaining useful life of the asset price. This is a separate discussion itself, so I don't want to get into much detail. Just wanted to give a flavor to you on what happens when we adopt a cost model, what happens when we adopt a revaluation model. Clear? Again, I will be just touching depreciation, just an overview. See, depreciation, everyone knows that how the depreciation amount is calculated: cost minus residual right divided by what? The useful life of the asset. Say, example, if the asset is 1 lakh, residual value assumed for that moment is nil, and you have used a straight line method. There are two methods of depreciation: straight line method. Useful life is 10 years. So every year, how much will be depreciated? 10,000. This is SLM. Okay. Another method is return on value. Okay. So assuming the rate of depreciation is 10%. So first year it will be 1 lakh minus 10%. So will be 10,000. Useful return on value after the end of the year will be 90,000. From 90,000, another 9,000 will be reduced. Okay, so it will become 81,000. So that is called as diminishing balance method. And the standard also permits units of production method. This will be useful in case of a factory. For example, if one machine produces, the maximum that one machine can produce is 1 lakh units. Another machine can produce 1,50,000 units. So based on the output, the depreciation is calculated. This is called as units of production method, guys. Okay. And when does depreciation start? The standard tells that whenever the machine is available for use. See, I have purchased a laptop from a vendor. Okay, see, in IT companies, generally what they do is they will have excess laptops because in case an employee joins today, will have to give a laptop. So there will be some excess laptop always available in stock. The laptop we have procured in the month of January, a new employee joins in the month of March. Okay, so from January to March, the laptop is procured. It is sitting in the Almira actually without use. Can depreciation be charged? Yes. In in the accounting standard, the IND AS 16, it tells that whenever the asset is available for use, the depreciation can be started. But in case of Income Tax Act, it is when the asset is put to use, then only the depreciation can be charged. So here the wording used is available for use. In income tax, it is put to use. Put to use means, in my example that I was giving, the depreciation can be charged only from March 2026, not from January 2026. Okay, but we are talking about books of accounts and depreciation under IND AS 16. In IND AS 16, the depreciation has to be charged from the date when the machine is available or the asset is available for use. Clear? What do you see in the slide, guys? You see an aircraft. Okay. An example that I'm going to give on component accounting. See, IND AS 16 tells that if a particular asset like aircraft, if a particular asset like aircraft has multiple parts inside it, and each part has a different useful life. Like for example, the engine will have a different useful life. Okay. The cockpit, the co the cockpit will have a different useful life. The body of the aircraft will have a different useful life. So if each part has a different useful life, the accounting standard IND AS 16 permits you to depreciate each part separately. Like engine will stay for 20 years and you know the cost of the engine. You can depreciate the engine separately at 20 years. The body, if it is only for 10 years, the body can be depreciated for a period of 10 years. This Secondary engine, there will be two engines, right? The secondary engine, if it is having a useful life of say 12 years, this can be depreciated for 12 years. So each part can be depreciated separately. Identify the component, break down the asset into significant parts within with different useful life. Allocate the cost, assign the total cost. See, to depreciate, we need to have a cost, right? So it's very important to allocate the cost to the engine separately, to the secondary engine separately, okay, to the body of the aircraft separately, allocate the cost and depreciate separately. Apply different useful life. For this engine, it will be 20 years. For this engine, secondary engine, it will be 12 years. For the aircraft body, it will be 10 years. Clear? Like here it is given, aircraft may have the airframe for 20 years, airframe for 20 years, engine for 10 years, and interior fittings for 5 years. Each can be depreciated separately. Clear? Derecognition criteria. Derecognition. What do you mean by derecognition? We talk about the recognition criteria, right? Exactly the opposite. Derecognition criteria. See, what was the recognition criteria? One is there has to be a future economic benefit, and second, the cost can be reliably measured. So, what will be the derecognition criteria? When there is no future economic benefit. From today onwards, I don't see any future benefit. That means this particular machine cannot produce anything, cannot generate sales, cannot generate revenue. There is no future economic benefit are expected from its use or disposal. If I'm going to use the machine, there is no economic benefit. If I'm going to dispose the machine, then also there is no economic benefit. This is the time when you have to de-recognize the asset. So what happens in case of de-recognition? The asset is sold or scrapped or otherwise disposed of. Okay. For example, if the written down value of the asset is 80,000 and I'm going to sell the asset for say 40,000 rupees. A asset which is in my books at a written down value of 80,000, if I'm going to sell for 40,000 rupees, there is a loss of 40,000 rupees. Immediately recognize this loss in the profit and loss account. If the same asset for 80,000 is sold for 1 lakh rupees, there is a profit of 20,000. Recognize the profit in the income statement as a gain on sale of asset. It has to be recognized in the profit and loss account. Whether it's a gain or loss, has to be recognized in the profit and loss account. So derecognition criteria is very simple. No future economic benefit means no future, no future economic benefit, guys. Excuse me for my handwriting. No future economic benefit means derecognize the asset, guys. Clear? So recognition criteria was there has to be a future economic benefit, and second recognition criteria was cost can be reliably measured. In derecognition criteria, only one criteria. If there is no future economic benefit, immediately the asset has to be derecognized from the books of account. When we derecognize the books of account, we calculate what? We compare the written down value. We compare the written down value with what? With the sale value. If the written down value is 80,000 and sale value is 40,000, 40 rupees loss. If the written down value is 80,000 and the sale value is 1 lakh rupees, so 20,000 rupees will be gain. Recognize the gain or loss in the profit and loss account, guys. Clear? This is all what I wanted to discuss in property, plant, and equipment, guys. So we started with definition of property, plant, and equipment. So it has to be a tangible asset. Second, if it is used for production or supply of goods or services or for rental to others or for administrative purposes, they qualify as property, plant, and equipment and should be expected to be used for more than 12 months. That is the definition which is given in the standard. Recognition criteria, two recognition criteria. One is future economic benefit and cost can be reliably measured. Then we discussed about cost. What can form part of the cost of PP? One is purchase price. any directly attributable cost to bring the asset to a location and condition which is ready to use. Fine. And drawing, designs, insurance, which is required to bring the asset to a location and condition that can be capitalized. What cannot be capitalized? Trial runs cannot be capitalized. Administrative costs cannot be capitalized. Opening ceremony cannot be capitalized. All those costs cannot be capitalized. Okay. So don't memorize anything, guys. Understand what can be capitalized. So we discussed about what can be capitalized, what cannot be capitalized. We discussed about depreciation. We discussed about component accounting in case of an aircraft. We discussed about two tests. What are the two tests again? One is there has to be future economic benefit, and second is cost can be reliably measured. And one more thing important is land is an exception. We cannot charge depreciation on land. Land is a non-depreciable asset in the accounting standard. Why? Because land is very limited resource actually. So as per the accounting standard, land is treated as a non-depreciable asset. Clear, guys? So this was it on my first series on simplifying IND AS. Hope you like this video. So if you like this video, please subscribe my channel, Learn Accountancy with Prasad R. Next week, I will be coming with another related topic. I'm yet to decide on the topic. Most likely, it can be borrowing cost, which is again attached to this topic actually. So stay with me, guys. Subscribe my channel and also subscribe my channel. My channel is Learn Accountancy with Prasad R in YouTube. In YouTube, it is by the name of Learn Accountancy with Prasad R. And I'm also available in LinkedIn. Those who want to reach me in LinkedIn, I'm available by the name of Prasad Ramachandran, guys. Okay. Have a great year ahead, 2026. Let's stay with me, guys. So let's break down more complex accounting standard into more simpler concepts. Thank you, guys. Stay tuned and looking forward to see you in the next session as well. Thank you so much.